real disposable income flat in June 2025. Inflation cancels all U.S. wage gains. In the United States, the situation regarding real disposable personal income, DPI, has taken a concerning turn, as it remained unchanged in July, with inflation effectively nullifying any wage increases. This is a critical issue that many may overlook, but it has significant implications for the economy and individual financial health. To break it down, while the DPI saw a nominal increase of 0.3%, this was countered by a corresponding rise in the Personal Consumption Expenditures (PCE) price index, which also increased by 0.3%. This means that when adjusted for inflation, the real income gain stands at a disappointing 0.0%. Essentially, the increase in income has been completely offset by rising prices, leaving consumers no better off than before. The Bureau of Economic Analysis, BEA, provided insights into the nominal rise in personal income, noting that the growth observed in June was largely due to heightened government social benefits and increased compensation. Specifically, Social Security payments played a significant role in this increase, as indicated by data from the Social Security Administration and the monthly Treasury statement. Furthermore, the rise in compensation included a notable increase of $10.9 billion in government wages and salaries, alongside $10.8 billion in supplements, which primarily consist of employer contributions to pension and insurance funds. Additionally, private wages and salaries saw an increase of $6.3 billion, according to the Bureau of Labor Statistics, BLS, Current Employment Statistics, CES. It's important to highlight that wages in goods-producing industries rose by $4.5 billion, while those in service-producing sectors increased by $1.9 billion. However, when we examine real personal income excluding government transfers, the picture becomes even more troubling. The National Bureau of Economic Research, NBER, which is responsible for determining recessions, reported a decline of 0.18% in real personal income excluding transfers in June, followed by a further drop of 0.16% in July. Looking ahead, the Committee for a Responsible Budget has raised alarms about the sustainability of Social Security and Medicare, predicting that these programs could face insolvency as early as 2033. This is a mere 8 years away, and the proposed One Big Beautiful Bill Act, OBBBA, could potentially accelerate this timeline to 2032. Elon Musk has controversially labeled Social Security as the biggest Ponzi scheme of all time, a statement that has sparked debate. While some like PolitiFact argue against this characterization, moreover, we are witnessing a demographic shift known as the Peak 65 moment, where approximately 11,000 individuals turn 65 every day for the next 3 years. This surge has resulted in nearly 40 million more people aged 65 and older compared to 2010, while only 9 million additional contributors are paying into Social Security. By 2035, the Social Security Administration estimates that there will be 77 million individuals aged 65 and older, which raises concerns about the program's viability. The Committee for a Responsible Budget believes that Social Security could be insolvent by 2032, a prediction that some may find overly optimistic, especially when considering potential recessions and decreased FICA payments. In conclusion, the current state of real, disposable personal income and the looming challenges facing Social Security and Medicare are issues that deserve our attention. As we navigate these complex economic waters, it's essential to engage in discussions about the future of these programs and the broader implications for our society. What are your thoughts on the sustainability of Social Security? Do you agree with Musk's assessment? Or do you think there are viable solutions to these pressing issues? Share your opinions in the comments below. U.S. personal income rises slightly in June amid mixed economic signals. When it comes to the financial health of households, small changes can have big implications. In June, personal income saw a modest uptick of 0.3%, bouncing back from a 0.4% decline in May, according to data released by the Bureau of Economic Analysis. This increase was primarily fueled by higher wages and expanded social benefits, offering some relief to families still grappling with economic uncertainty. However, there's a catch. This growth rate is far slower than the impressive 1.4% monthly surge recorded in January 2024. What does this mean for the average person trying to make ends meet? Let's dive deeper. But here's where it gets controversial. While personal income may be inching up, real disposable income, the money left over after taxes and inflation are factored in, remains stagnant in June. This follows a concerning 0.7% drop in May. On paper, real disposable income rose by 1.7% compared to the same time last year. But that number pales in comparison to the staggering 6.5% annual growth seen in June 2023. The slowdown raises an important question. Are we witnessing the early signs of a broader economic shift? Consumer spending, another key indicator of economic vitality, also showed signs of losing steam. Personal consumption expenditures grew by just 0.3% in June, barely moving the needle after staying flat in May. When adjusted for inflation, real spending increased by only 0.1%. Breaking it down further, spending on goods and services both climbed by 0.1%. While these numbers might seem minor, they signal a potential cooling in consumer confidence. With inflation continuing to eat away at wage increases, many households are dipping into their savings to maintain their current lifestyles. Over time, this unsustainable trend could result in a significant pullback in consumer spending, which accounts for roughly 2/3 of the U.S. economy. Is the nation headed for a period of belt-tightening? So, what do you think? Are these trends simply short-term fluctuations, or do they hint at deeper systemic issues? Do you believe policymakers are doing enough to address the challenges facing everyday Americans? Share your thoughts in the comments below. We'd love to hear your perspective. Stay informed about housing and economic trends by subscribing to Eye on Housing. Get the latest insights delivered straight to your inbox. Market Minute. Consumer spending slows amid economic uncertainty. Brace yourself. Consumer spending appears to be losing momentum, and the reasons behind this slowdown are both complex and widely debated. But here's where it gets controversial. As Americans navigate economic uncertainty, their willingness to spend is tapering off more noticeably than expected. This shift isn't just a blip. It could signal a fundamental change in how households approach their finances amid rising inflation and a cooling labor market. Let's unpack what's happening. Data from the first half of this year shows that personal consumption expenditures, basically how much people are spending, are gradually losing steam. This can be seen in the slowing growth rates since early 2021, a natural correction after the pandemic-driven boom and the distortions it caused. From April 2021 to February 2023, real consumer spending, adjusted for inflation, expanded at an average of about 8.7% per year. But over the following 22 months, growth slowed to roughly 5.4% annually, reflecting a more cautious consumer base. And experts expect this downward trend to continue. June's data is forecasted to show a modest 0.3% uptick in consumer spending, following a slight decline in May. This suggests that while some Americans are still out there spending, the pace isn't nearly as vigorous as it once was. In fact, the weak growth figures for recent months correlate with softer home sales, sluggish auto sales, a decline in weekly working hours, and a shrinking labor pool. All signs that less spending power is filtering through the economy. Adding to the weight of evidence, rising taxes, especially on imports, are prompting households to tighten their belts, reducing expenses across the board. This behavior is what many economists predicted. After the initial pandemic stimulus burst, consumers began to pull back, especially as inflation started to eat into their budgets. Looking ahead, the picture becomes even more intriguing. If prices continue to climb and consumers keep their spending cautious, whole quarters could see near-flat growth in household expenditures. Meanwhile, inventory levels are bound to normalize eventually, and firms will reach the limits of product substitution, forcing companies to choose between fighting for market share and protecting their profit margins. All these factors point toward a potential tightening of corporate profit margins in the coming months, which could further slow hiring and wage growth, closing off additional income streams for households. In essence, this cycle might lead to a stagnant or even contracting consumer sector, posing challenges to the broader economy. And this is where opinions diverge. Some argue that this slowdown is just a temporary pause and that pent-up demand will reignite spending later in the year. Others believe it signals a more prolonged adjustment, possibly a shift toward more sustainable consumption patterns. What's your take? Do you see these signs as a blip or the start of something more significant? Share your thoughts. This debate isn't just about numbers. It's about the future of everyday life for millions.